Thank you everybody for joining today. We've got some good info we're going to go over. A little bit of a roadmap. We'll do some quick introductions. I'll set the stage a little bit on what crowdfunding is and some of the regulatory environment that got us to where we are. I'll turn it over to Bruce and Terry, and they'll talk about why you should be paying attention to it these days. And then we'll wrap up with some results from a survey that we just did recently for all the investors on RealCrowd, and some general best practices and what we're seeing in the space. So as Tyler said, I am the CEO and founder of RealCrowd. We started the company a little over 9 years ago now, which is kind of crazy. It's been that long. Feels like it was only a couple of years. And we operate a direct investment marketplace for managers of real estate to raise capital through this new regulatory environment from accredited investors all around the country. Since we started, we've had managers raise capital for over $8 billion of real estate on the platform, all different product types, about 40 different states around the country. So we've got a pretty broad coverage. Bruce Stackenfeld is one of the nation's preeminent real estate attorneys. He's a founding partner of the firm, founder of the firm's real estate practice group, and he's also the firm's chairman. He is rumored to be one of the most connected real estate lawyers throughout the real estate community. Terry Adler is the firm's managing partner and member of the management committee. She was recently named one of the top 100 female lawyers in New York City by Crain's and is recognized for her distinguished career and exceptional civic and philanthropic activities. And we'll let them give a little bit more of an intro on their firm and what they do once we turn it over for their portion of the presentation. So as a quick primer on how we got to where we are, in 2012, the original Jobs Act, which was a Jumpstart or Business Startups Act, was intended to ease access to capital for small businesses. So if a cafe owner or a consumer products company was trying to raise capital to start or grow their business, the regulations were designed to help them access capital through a few different mechanisms. We'll talk about two that we haven't really seen a ton of in the real estate space, and then we'll talk about primarily where we operate. The first one, which I think most people think of when they hear crowdfunding, is true regulation crowdfunding. And for a long time, this was limited to $1 million a year per company that you could raise. You could raise capital from non-accredited investors, but there were some additional regulatory filings and audit requirements and financial reporting requirements that you had to do to get that. We haven't seen much of that in the real estate space. Again, the $1 million per year cap seemed a little bit prohibitive. Recently, though, that was changed to $5 million. So you can raise up to $5 million from non-accredited investors. It's interesting. It's something that we're paying attention to. We still haven't seen a lot of adoption in that space from the real estate industry, but something that we think might pick up more steam now that that's raised up to $5 million. Another one that was part of the Jobs Act was Regulation A+. This is basically a mini IPO. This raised the cap to 50 million, and I believe now, Bruce, it's even up to 75. Is up 75 million for Reg A Plus now. I think they raised that cap as well. Platforms like Fundraising have taken huge advantage of the Regulation A Plus. I think they've been the biggest in the real estate space to leverage this environment. Again, it's basically a registered security, so you have to go through SEC approval. Earlier days, we were seeing probably 9 to 12 months to get something through the SEC, and probably 250, 300,000 in legal to get a Reg A Plus offering up. So we didn't see a lot of interest in that in the real estate space either. What we did see, though, was Reg D general solicitations. So Regulation D was basically how private offerings are conducted historically. So the old way of doing this was called a 506B transaction, true private placement, no general solicitations, offering it to investors that you already kind of had in your network, you had a pre-existing business relationship with. What the Jobs Act changed was it created this separate registration called Rule 506C, which we'll talk about what's different about that and what's the same. So as you can see here, both Rule 506B and Rule 506C, you can have an unlimited number of investors and you can raise an unlimited amount of capital into those kinds of offerings. When we start to look at the differences, in the 506B, you can have accredited investors and you can have a small subset of non-accredited investors, assuming that they're sophisticated or related to the issuer. In the 506C world, when you make a general solicitation, they have to be accredited. And that's one of the biggest changes administratively from those two regulations, is when you make a general solicitation, the trade-off is that you have to basically prove that these people are accredited. You have to take reasonable steps to verify that all of the investors are accredited. So no non-accredited investors in those offerings. And that's all in exchange for being able to make these public advertisements. And so essentially what the Jobs Act did was it made a way to publicly solicit these private offerings. So the internet, newspapers, radio, TV, banners, sandwich board, whatever, you can now publicly advertise these private investments. That was a huge change, right? And so when we started the company, we were seeing some rewards-based platforms, Kickstarter, Indiegogo, these donations or rewards-based crowdfunding platforms where you make a contribution, you get a coffee mug or you get an early release of a CD. And when the regulatory change allowed for that same kind of advertisement for these investments, these equity investments, we thought there was a huge opportunity to basically leverage the internet as a distribution channel for people who are trying to raise capital to reach a whole new audience that they couldn't get in front of before. And that's really the biggest change of what happened with this regulatory environment is now you can use the internet as a distribution channel. You can put your offering out there to a new audience that you didn't have a relationship with, and then try to build that trust and ultimately convert those investors into new clients and new investors into your deals. So that's a kind of a quick rundown, and I know that's a lot to run through, but I thought that would kind of set the stage a little bit for what Bruce and Terry are going to talk about. When we look at how real estate managers can interact with these different crowdfunding or capital raising platforms, there's three main business models that we'll talk about. First is a proprietary platform where, as a real estate manager, you white label or you build your own software platform to offer your own investments through a public channel. So you would build your own proprietary software to basically advertise your deals and try to reach a new audience. The next one is what we call an aggregator platform. That's where the platform itself will form an entity. They'll form an LLC for every deal. They'll take the investors into that LLC, and then they'll invest with the real estate manager. So there's a bit of a disintermediation there between the end investor and the real estate manager, with an aggregator platform kind of in the middle. Can be kind of a heavy fee load on those deals. Sometimes platforms are taking in the promote, and ultimately there's no direct connection between the investor and the real estate manager. And the third, which is what we operate, is a direct marketplace, a direct platform. So on RealCrowd, the investors have a direct relationship with the real estate managers. We don't form entities in the middle. You have that relationship, and that's something that we've always felt is crucial to the real estate space, is that relationship between the investor and the manager. And so on the RealCrowd marketplace, again, investors get to interact directly with the real estate manager. That's their relationship to own and manage and report to you down the road. So I think that's enough of kind of the high-level overview. I will turn it over now to Bruce and Terry to tell us a little bit about their firm and what they're seeing in the crowdfunding space here in 2022.
Adam, thanks for having us on the show. Terry and I are sincerely honored to be here. We've been mixed into the crowdfunding space now, I don't even know how many years, but it gets more and more interesting. So a very quick word about Duval and Stackenfeld. We're a law firm. You can't hide that. We are a law firm. We're in New York City. We have one office. We have about 50 real estate lawyers. Our clients do just about everything throughout the capital stack. But our heart and soul really is in what we call corporate real estate, which includes joint ventures, platforms, and all sorts of things. And yes, drum roll, of course, it includes crowdfunding. The key differentiator of our firm, without going into the normal stuff that lawyers talk about, is 6 words. And this is the heart of our business model, and it fits kind of perfectly into the crowdfunding space. The 6 words are: help our clients grow their business. That's our magic formula, our secret sauce. Pick whatever metaphor you like. That's what's special about us. We know we're not the only good real estate law firm out there. We do have competition. The way we differentiate is learning what our clients care about. One thing our sponsor clients care about, often more than just about anything else, is the ability to get capital and figure out how to get capital for their transaction sites. It's very difficult. It's especially difficult when it's small amounts of money, and crowdfunding, as we'll talk about, fits very nicely into this. So I'm the chairman of the firm. I founded the firm. Amazingly, if we don't do anything really stupid, for about 7 more months, we will be 25 years old. which is kind of a miracle, when I look back on all the things that have happened over that time. I'm with my partner, Terry Adler. Terry also founded the firm with me. She now runs the firm, and she's the managing partner, and I'm the chairman. Sometimes people think of Terry and me, since we've been together so long, even before the firm, as one word. Bruce and Terry, it's one word, and some people think it sounds like a disease of the bowels. Happily, it is not. It is me and Terry working together. Anyway, that's a very quick background on us. Let's launch into crowdfunding. So I really like movies. One movie I saw a long time ago, which I think is pretty funny, is called Gold Member. Okay, and you may remember in this movie, and I'm betting almost everyone's seen it because it's one of those movies everyone's seen. There's this scene where Dr. Evil, and I can always get the pinky wrong, but he's decided to blackmail the world. Okay, he's blackmailing the world, and then he announces it on this TV. I'm going to blackmail the world for $1 million. And everybody starts laughing at him. And for some reason, that always makes me think of crowdfunding. Because when it started out, as Adam already pointed out, it started out with $1 million. And what that meant was it was kind of a bit of a black eye for crowdfunding, because everybody just said, oh yeah, that's really got nothing to do with me, $1 million. But then, as we all know, it's kind of like this concept of disruptive technologies. For people who read books like The Innovator's Dilemma, it started to creep up. It was like 1 million or even less at first, and then it was like 1 million or 2, and then some of the biggies could say, hey, I think I could get you 3 million, then it was 5, then it was 10, now it's in the teens is a kind of a normal one, and even in the 20s, and occasionally Adam, I think you may have cracked 30 by now, and it just keeps getting bigger and bigger. Suddenly there's actually real money involved in the crowdfunding space. So to sort of be a little bit provocative and also obvious here as well, if I'm a sponsor and I'm trying to raise money for my transactions, I stick my neck out by saying crowdfunding should be in the toolbox. And especially when you start thinking about small amounts of money, and when I say small, I mean like 5, 10-ish $million. You can't raise that on a traditional platform. Like if you go to a placement agent and you say, I'd like you to help me raise $5 million, it'll sort of be like Dr. Evil again. They'll laugh at you. They'll say, I'm not taking a $5 million capital raise. It's a big waste of my time. It's tricky capital. It's a pain in the neck. No. And I know this firsthand, because one of the things I do a ton of with the clients is trying to help them raise sometimes small amounts of money. The way I do it, you call up a whole bunch of parties and see if you can get one that will give you the money. So one option is going to a placement agent, forget about that. And the other one, to quote another movie, I'm sure you all probably were forced to watch Oliver Twist when you were little, and I'm sure nobody can forget that hideous scene, he goes, please, sir, can I have some more? That was really bad accent, but that's the best I could do. But if you think about it, that's what you end up doing when you go to a big money fund investor, a huge pile of capital that's got $1 billion, and you're asking for $5 million or 10 million even, you're hat in hand, and they don't want to do it because it's just too small. It's too annoying. Okay, so what should be happening, I think, for a sponsor, it's not something that crowdfunding fits every deal, and there's a lot of issues and subtleties as Terry's going to talk about, and Adam already led us through some of the the tricky little places. But it's definitely something that one should have in the toolbox for transactions. So that's my first point. My second point is I guess now that I think about it, I'm really making the 2 points together, which is this. It's difficult to raise small amounts. You probably even heard that saying. It's a lot harder to raise 5 million than 100 million. And the crowdfunding, and I don't want to be redundant, really hits that right smack in where it should be, because it's the kind of capital that Adam and his team are able to raise for their clients. So, all right, I'm going to stop there. I'm going to turn it over to Terry, who I will give one plug to. Adam, you said Terry was known as one of the top 50 female real estate lawyers in New York City. Yes, that is true. But I feel very confident, and I know her firsthand. She is the absolute top real estate lawyer in New York City, and anyone who's worked with her comes to that same conclusion. So Terry, I'm going to turn it over to you to talk about the the legal spots in the crowdfunding.
Thank you, Bruce. I think that the having Bruce say I'm the #1 lawyer in the city, I think is like having, you know, when your parents say you're the smartest kid in the class. So, so you know, I am I'm the person that does a lot of the fundraising here, the traditional, more, you know, bigger funds, 100 million, 200 million, those sorts of things, and then also the crowdfunding type platforms. And you know, it's been an amazing development in capital raising. And I used to, you know, when I first started dating my husband, I would go out and meet his friends, and they would all say, "Oh, you're in real estate? I want to buy a building. I'm going to buy a building and I'm going to run it." And I'm like, "You'll have no idea what you're going to do. You're going to lose all your money. Go give money to somebody who knows how to do real estate." And of course, there's a barrier to entry there, right? The small checks are not appealing to big operators or even mid-size operators. A lot of sponsors would do syndications where on a deal by deal basis, they would be passing the hat, friends and family. And that was really the only point of access for somebody who couldn't write a 6+ you know, digit check. So what CrowdStreet and crowdfunding, Real Crowd, all these other things have done is they've really opened up the avenue by which you can raise capital. And to Bruce's point, while it may have started out small, it has gotten very big. And we have done capital raises that are, you know, upwards of $50+ million. And what people I think get a little confused or you know, sort of caught in is there is this thing called Regulation CF, which is regulation crowdfunding. However, that is a somewhat limited slice as to what crowdfunding really is and what Adam and his team does at Real Crowd. So, you know, Regulation CF is small checks, no more than 5 million in any 12-month period, has some real limitations to it. What we do, what I think Adam probably does, and what I think is what is much more interesting as a capital raise mechanism is to allow you to get this unlimited number of investors who can write bigger checks and raise bigger amounts of money and not have that 12-year or 12-month limitation. So, you know, it has actually opened up a door and another source of capital for people who have transactions, and not just real estate, any kind of transaction where they need seed capital, they need to raise funds, and they can go to a platform like Real Crowd and Adam and say, "Hey, you know, can I go up on your platform?" You do the flip book, you come up with a PPM and all the applicable documents, and then that ease of going online, being able to peruse that, clicking through, and being able to get access to the sponsors of these deals or these companies and invest your capital has really revolutionized access to deals that people never saw. They never even knew they were out there. And so for all those friends of my husband's who wanted to do real estate deals, all of a sudden now they have access to them in a way that they never did before. And the nice thing about it is that you're still getting the level of disclosure that the guy who's writing the $100 million check is getting. PPMs are the same. The fund documents, the subscription agreements, the requirements are largely the same from a legal standpoint. So, you know, you're getting the protections. You're not going in blind. You're not going to have a ton of rights, that's for sure, because you're writing smaller checks. But from a sponsor standpoint, you know, this is just opening the door, because if you only need 10 million of cash, you're not going to get attention from a money fund or an institution. And you can build your base, build your platform, build your company and portfolio through these types of capital raises, and, you know, ultimately take your company to a completely different level. So it's really revolutionized capital raise. It's really kicked off, I think, you know, over the course of the last several years, even with COVID and all the interruptions that presented. So, you know, the first time through is always tough. You have to, if you've never done a fund offering, you have to do the documents, risk factors. The PPM is very long. You spend a lot of time talking to your very charming lawyer who is going to tell you all the things that you need to do. But once you've done it once, then it's largely rinse and repeat. You're largely pushing out the same documents, changing the, some of the risk factors, the descriptions, obviously marketing materials and things like that. But a lot of the baseline documents stay the same. And so you get efficient.
And Terry, I was going to jump in there. I think that's one of the most important things that, 9 years into this, we're still having conversations with managers that we were having when we started the company, is that they're mechanically and from a paperwork and documentation perspective, there's really nothing different from how they've raised capital for decades, right? Private placements, Reg D private offerings, it's the same process. The difference is that now you can offer that to people that you didn't have a pre-existing relationship with. And again, a little different accreditation standard, right? And that's the biggest change from a functional perspective when you do this, but the process, generating PPM, disclosure documents, subscription process, it's really unchanged from how a lot of the listeners on this have raised capital for the last, for decades with these private placements.
Yeah, without question. And even that requirement, when you're doing a general solicitation under 506C, there are now companies that called like Verify Investor, or I forget some of the others, that will actually provide that certification for you, so that, you're not, because it's like a CPA letter, you've got to, you're not going to want to track down every single investor and try to, get that from them individually. So there are companies that are now providing that service. So, as a need arises, somebody comes up with a business idea to address the issue. So, that general solicitation, which had some, that, oh, well, I've got to verify that accredited investor status, I got to go find their CPA, now has a new step streamlined to get that done. So, it's really, I think, been a great, as Bruce said, sort of put it in your toolbox as a means to raise capital when your friends and family are tapped out, or, and for what it's worth, and, to jinx anything, but when we've had clients go on platforms like Real Crowd, you don't get on the platform unless they're confident they're going to get the capital for you. And so you once you're on it, once you've cleared their process, it's very fast. We've had people raise their capital in a week, 2 weeks at the most. Yes, sometimes it takes longer when it's a bigger number, but to date, and I'm knocking wood, you guys can't see, but every crowd-funded platform that our clients have gone, or deal that they've put on a platform, has succeeded and raised the capital, and often is oversubscribed.
So it sounds like the incredibly good news, and we're very superstitious here. It's knocking on wood and everything else, but it sounds like, to the extent there's like a, trying anything new, or like for me, trying to like work an iPhone was a beyond nightmare. But once you kind of get the thing going, you can actually talk to people on it and send emails and all sorts of things. And it sounds like the crowdfunding is the same thing. Yeah, there's a bit of a hassle the first time you do it. You have to, go through the platform, but then it really becomes, dare I say, a cash machine where somebody can just keep doing it again and again, very simply, very inexpensively in terms of the overall costs and everything else. And one thing that is very nice, and Adam already mentioned it about the Real Crowd platform, is something that's near and dear to sponsors' hearts, is that it is basically building relationships. Okay, if an investor invests in the first deal, it came through the platform. You don't know who it is. His name is Toby Jones or something, and he's writing a $500,000 check. But he's in your deal. You get to know Toby, presumably on a personal level, because it's a $500,000 check, and then he's a relationship that you have for the next deal, and the next deal, and the next deal. And it's a way to not only build the money for the transactions in hand, but also to build a base of parties that for passing the hat or whatever else it is that you're doing. So anyway, that was sort of just an aside. I think, Terry, you're still up with I don't know.
Yeah, look, I think that,
I'll just throw a quick point on Bruce, what you just mentioned there. We've seen that a number of times where, again, you have to understand these are investors that are coming to an online platform, and they're going to invest, a not insignificant amount of money, right? So oftentimes on our marketplace, we'll see minimum investments in that $25,000 to $50,000 range. We see it a lot where someone will invest $25,000 with a sponsor, get to know them. A couple months later, they'll launch the next deal. Maybe they put in $100,000 on that deal. A couple of months later, they'll launch another deal. Maybe they put in $500,000 on that deal, right? So I think the ability to kind of build those relationships and see those check size increase. We've heard that from a number of managers where the first one will be around the minimum, just as kind of like a get to know you. And then we'll show some stats here in terms of how people are looking at investing in the space. Certainly the ability to grow those relationships and have them reinvest at much higher tickets. We see that happen quite a lot on the marketplace.
Hey, one question for you, Adam, and I think I know the answer to it, but one thing that I hear consistently as a negative from sponsors is, Bruce, I don't really want somebody writing a $25,000 check. That's the last thing I need. I believe, and tell me if I got this right, Terry and Adam, that you can set the parameters yourself. You could say only checks over $1 million. Now you might not get any investors, okay, and that would be a bummer. But the sponsor, working with Adam and his team, have the right to determine the characteristics of the proposed investors. So you're not going to get checks for $25,000 if you turn them down. Is that right, Adam, Terry?
Yeah, that is right. So the sponsor sets the terms, right? It's their offering. We're a platform in a marketplace for that sponsor to basically offer their investment structure to the network of people on the marketplace. So generally, though, we do see minimums in that 25 to 50,000. We've seen some funds at 100,000. But yes, it's 100%. It's the sponsor's offering. It's their documents. Oftentimes, it's the same. And always, actually, it's the same terms as what they're raising capital offline, right? They're not using a separate set of documents for raising capital online. So whatever they're syndicating from friends and family or other investors offline, they'll offer those same terms to the investors online as well.
Right,
So
and I do think that the interesting thing with the crowdfunding platform is that we have a client that we just did a crowdfunded deal, and they raised roughly around $50 million, and we're doing a private placement through a wealth manager, and they're raising $290 million. And so you're not exclusive. If you need those super chunky checks that maybe you can't get from a crowdfunded platform, this is not exclusive. This is something that is just such a great opportunity for people to both make investments and also raise capital for their investments that maybe are just something that they're either starting out, this is their first time, they've never done a fund before, they've only ever done friends and family, this is a good entry point. If they have a nice track record, Adam and his team does a great job of helping you set yourself up and be as attractive to the pool of investors that they have as possible. And then you develop those relationships, and you also develop the muscle of having to do the reporting and having a pool of investors and doing investor relations and all of that, which can really set you up in the future for just increasing those capital raise numbers and getting some chops and some background on how that has to work. And you're doing your blue sky filings, and you're having to jump through those hoops that are baby step hoops in terms of if somebody wants to one day become a registered investment advisor, which is, a totally different ball of wax. So, this is, I just think, again, it's you can always just be somebody that's deal by deal going out and raising the money this way, or you can use this as a platform to grow and expand your business to maybe take it to the next level.
So one thing I'll add here, and you can see, look, we're all fans of this space, and look, as lawyers, we're out to help our clients grow, yes, but also to protect our clients. We're not, fans, just on some bandwagon. We really think this is advantageous to our clients. One other thing I'm going to add here is kind of what I would call the flexibility of it. I alluded before, how difficult it is to try to raise like $5 million. And I know even the crowdfunding platforms want to raise more now. But if you're looking for a chunk of money that is maybe in an unusual place in the capital stack or whatnot, this stuff really can be, as long as it's something that, that say Adam and his team think would be reasonably attractive to investors, you can do it. So for example, it could be nice, boring, limited partner capital. You're the GP, there's an LP, and the LP is basically the syndication for crowdfunding money. If they were from 1 million to 50 million, whatever it happens to be, and it's nice and boring and nice and simple, and it's perfectly fine. Okay, that's a good one. Perhaps you're raising a so-called GP capital fund or sponsor capital fund of, I don't know, 25, 30, 40, 50 million dollars. And, you got a bunch of people that are giving you 10 or 15 or 20, but you're trying to get another 5 or 10. It is very possible that crowdfunding could aggregate to 5 or 10 or more million dollars on your sponsor capital fund. It's a whole other discussion, but for sponsors, a sponsor capital fund is a creature of just beauty to have. It's so flexible and wonderful, and this is a potential way to raise it. Also consider transaction. Maybe you've already closed. Maybe it's stable or getting stabilized, and you put, I don't know, 10 million into it, and you wouldn't mind getting some of that out. And maybe you're going to try to sell off 4.99 or 49% of that $10 million. Obviously, you're going to need the consent of maybe your money partner, your lender, or whatnot, or maybe you were smart enough to build that in ahead of time. But it's certainly a way to maybe take 49% or even more out of that money that you've already got. You have that money back, syndicated out that deal, and now your risk is smaller, and hopefully you're keeping your promote as well. But now you have that cash back to do another deal. There's all different ways to put the money into the capital stack. It could be preferred equity. It could pretty much be just about anything. So I do kind of like that flexibility factor. I guess this goes back to you, Terry. Okay, go ahead, Adam.
We've seen, so the majority of what we see on the marketplace are single asset acquisitions. So it'll be a sponsor that's got a property tied up. They're going through their capital raise through their existing investors. And I think, Terry, to your point, we look at this as an augment to the capital that they're raising offline as well, right? So we don't see this necessarily as a replacement entirely of their capital. This is more of an augment for them to kind of grow their investor network and reach a new pool of capital. So most of what we see are single asset acquisitions. To your point, Bruce, so we've seen a number of funds where they're raising, a 50 or 100 or $250 million fund. They can raise a portion of that through a marketplace or platform like ours. We have seen a GP co-invest fund from time to time. We've done a few preferred equity pieces from time to time. We on Real Crowd, we don't do any debt or mezzanine. There are some platforms out there that will originate loan, debt products. We don't do that, so we're purely on the equity side. But yeah, it's very flexible in terms of structure, in terms of where in the capital stack, and the type of equity that people are offering on the marketplace for sure.
Well, let me ask you a question that you're going to be surprised I'm asking you, Adam, but I think actually might be of more interest to your sponsors than I think any of us were guessing beforehand. Can you still raise $1 million? And the reason I ask that is sometimes there's like little spots that somebody, and I get calls like this almost once a week. Somebody's saying, I got my money together. I need 8 million. I've raised 6.3. I need 1.7. Can you help me? The answer is no. I have no one in the world that would even look at that. Is it still something that your platform can accommodate small amounts that can help out? And the reason I also ask you this question, Adam, is to the extent, a sponsor may be listening to this webcast here, is getting their feet wet by saying, if I could get $1 million for this thing, it would kind of get me, into the game of understanding how to do this. And then of course I could build from there. But let me ask you that question. Can you still do small amounts?
Absolutely. And I think that's, that middle market equity that's why I started the company, right? So my career prior to this was doing joint venture equity for real estate transactions. And I remember specifically that the deal that made us start this platform, we were selling it was like a $13 million building down in Northern California. And we ended up listing, the firm that I was at, we ended up listing a sister building office property just down the road, another $14-15 million transaction. And we told the sponsor, like, hey, this we just listed this other one, economies of scale, you should look at buying this one too. And he looked at us, he's like, guys, I can't shut down my office again, kiss my wife and kids goodbye, and go do another road show to raise another $5 or $6 million. And I couldn't do anything, as you mentioned, right? As a institutional equity guy, no one's going to touch that. And so seeing that need for these sub-institutional size capital raises, call it sub 35, $40 million total transaction size, that's 100% our bread and butter. And I think that is the most difficult part of the capital stack to capitalize, right? That's the hardest piece of equity to fill. So that's very much still, there's a huge need for that $2 to $5 million of equity. Yes, we've done deals that have raised multiples of that, but that is still kind of where we see the most value in the bread and butter, is those transactions where it's, you can't get that from an institution, right? You can't get that from a traditional capital source. Maybe some of the smaller family offices, or you talk to, Blue Vista or Appian, and if those two don't bite, then, you're kind of on your own. So I think that is certainly a large part of the business that we've continued to focus on. I know some of the other platforms have started to move maybe outside of that range and have kind of left a lot of their clients by the wayside in those smaller capital raises, and they're not going to take on a deal that's less than 5 million, right? We know there's still a huge need in the capital markets for chunks that size, and that's still where we spend a lot of our time on those kind of sub $5 million deals for people that need that for sure.
It's also very interesting to your point. I mean, we have situations where somebody is really, drinking from a fire hose on their deal pipeline, and they can't get their capital fast enough. And, your platform provides them a means of doing that. Once you go through one fundraise, and then you're rinsing and repeating those documents, you get into the groove of it, you understand it, and, time kills deals. And so when you have this access to capital with this platform, it really enables you to fast track, hopefully your capital raise when you've really tapped out either yourself or your friends and family network or whatever other sources of capital you have. Hate turning deals away.
So I think our last point before maybe, turning it back to you, Adam, or Q&A or whatever the next thing is, one of the things that sponsors always wonder about, and it's kind of the elephant, or I don't know if it's a moose or even a chicken now in the room, but it's kind of like, you're doing, Adam, a best efforts offering. You're not promising to the sponsor, hey, you want 5 million, you got it. Just shake my hand. You're not doing that. You're saying, we'll put you on the platform. And then I think the thing, I think Terry was pointing this out earlier, you're going to vet that sponsor very carefully, and you're going to come to a conclusion that, look, the odds are extremely good that that sponsor is going to succeed, because the last thing you want is an offering that doesn't succeed. As Terry mentioned, every single one we've tried, it's succeeded. But what is, kind of what are the odds of an offering, hitting the goal once, say, Adam, you've signed off on it and said, this feels like one that our investor group would like. And before I shut up and then turn to Terry, it's kind of like, well, if you're the sponsor, even if the odds are 98%, you still have to at least think about, what are you going to do if, God forbid, something goes wrong, or, a war breaks out or something like that, and suddenly the offering, actually doesn't happen. People get scared and stop investing. As Terry would be the first to tell you, you don't want to be in a situation where you put down a $5 million hard deposit, you've got 18 days to close, and all of a sudden something goes wrong. So starting, maybe Adam, what are the chances now on your platform, you're going to hit a winner once you say, let's go?
Yeah, as you mentioned, I mean, it is best efforts, right? So there is a risk there of, we don't, on Real Crowd, we don't control the lever that says, hey, this person, you got to invest in this thing, right? So there is always some risk there of that certainty of closing these investments. It's something, again, we'll talk about here in a few minutes, kind of what we're seeing on the marketplace in terms of desire, right? There are certain deal characteristics that are more attractive to investors than others. Certainly, when you look at the kind of core plus type of return profiles, you have to put yourself in the mind of these investors. They're self-directed. A lot of them are day traders. They're coming to a website to invest large amounts of capital. Generally, they're pretty risk on kinds of investors, right? So they're looking for a lot higher yields and maybe some of the core plus deals that would be out there. So I think in terms of positioning the type of investment that would be attractive to this investor set, I think that's an important piece of it. Generally, though, I mean, again, the managers that we work with, they have the means to close the transaction, whether they raise all of it or none of it or half of it through the marketplace, right? I think it's important to be able to close the transaction. And then, as you mentioned, Bruce, we've seen a number of them where, just given timing, maybe we get involved really late in the game, they'll close with a portion of it on their balance sheet and continue to syndicate that post-close. Maybe, if they have to bring in a bridge facility, and they can take that out post-close if they don't come to us early enough in the process. So having that flexibility is always important, and understanding that, again, it is a best efforts process, and there is that risk. But, again, identifying the right kind of deal that will be attracted to this audience, I think, is one of the most important keys for sure.
Okay. And okay, oh, that's kind of what I thought. I mean, and the odds are really good, and you have to have some plan to deal with an unexpected circumstance on it. And I don't know, Terry, if you have any magic ideas other than make sure you close.
I think that people like real estate investments. I think they feel like they're safer. I think you've got some sectors right now that are struggling in real estate. But when you mention things like pandemic, war, inflation, I mean, everything that could happen seems to be happening and unfolding in front of our face, and yet there's still a very robust appetite for real estate. And I know, Adam, we were talking before about those different sectors and what people are looking for, and again, the beauty of the platform is to be able to surf that and find and diversify your own holdings, right? You can decide, I want to be in that higher risk retail deal because I'm big on retail, right? And hedge it by investing in a multifamily. So, that's the kind of access in it that you just, and you're controlling it as opposed to just giving your money blind to somebody who's going to decide where they're putting it.
So building off of that, and one surprise, and Adam, I know I've heard this before, but big surprise, I would have thought that these investors would be, risk avoiding coupon clippers, sort of like me, basically, getting older, don't want to lose their money. I don't want to take any risks. And are like, wow, I'm going to get 4.5% yield, nice and safe. Oh my God, I'm like so happy. Oh, thank God. But it seems like instead, at least to my surprise, that it seems like a large percentage of your investors are the opposite of that. They're ones that, recognize, of course, there's more risk, but they would rather take more risk for a higher, higher potential IRR, higher reward. And what was just triggering my thinking here, based on what Terry was just saying, is, the two, redheaded stepchilds or whatever they are, the wretched parties in the real estate world seem to be retail and hospitality now. And I'm wondering, speak to the sponsors, if sponsors are looking at, buying into these troubled asset classes, obviously with a plan to create a lot of upside, is crowdfunding like the perfect place for them to go? Because yeah, there's more risk, but the reward is dramatically higher, or am I off base there?
Yeah, I think that's actually a good transition into kind of what we've seen in the marketplace, and I can go through here the survey a little bit before we leave some time for Q&A. So generally, again, just some best practices of what we've seen. When you look at investment structure, keep it simple, right? Oftentimes, a simple promote is going to be far more attractive than a multi-tiered waterfall. Anytime you add complexity to a structure, when you add multiple hurdle rates, it just can, investors, again, they're not real estate experts necessarily. Maybe this is the first time they're having access to these private deals. So simple structure we've seen far more attractive than more complicated waterfalls. Market-based fees are fine. That's a question we get a lot from sponsors. Acquisition fee, asset management fees, property management, disposition fees. Those are all, so long as they're within market ranges, there's nothing egregious generally. Investors are sensitive to fees, but they understand that that's part of the transaction, and those are okay. To what we were just talking about, they are definitely returns-driven investors, and I think that's been one of the more frustrating parts as a real estate guy is seeing A+ real estate, A+ manager, great strategy, but if it's a core plus type return next to a higher higher leverage, higher value add kind of a deal, the ones with the lower returns, just they quite frankly don't get the funding, and that's actually a reason why we launched a sister platform, which we're not going to talk too much about today, called Reallocate. You just head to reallocate.com, where we're working with wealth managers and RIAs to help get their clients into these private deals around this kind of lens of risk, right? So there's a much more kind of capital preservation tone and slant towards investors in the wealth management space. And so that's a really interesting platform that we're working on right now, where we're helping get access to a broader segment of that capital that can fund up and down that risk spectrum. So generally, though, on the marketplace, we see much more kind of higher octane capital that they're looking for, better returns than those kind of core plus deals. Earlier this year, we did a quick survey just with everything that was going on. Obviously, with the war in Ukraine that Bruce mentioned, covering off the pandemic, inflation concerns, we did a quick flash poll of our investors just to kind of see what the sentiment was for real estate. Overwhelming interest in commercial real estate. Now, again, granted, this is our users, right? So they're going to be biased towards wanting to do real estate, but 95% said they're going to add more commercial real estate to their portfolio this year. That was a great response, right? We're very, very pleased that there's 95% of our people that responded to this wanted to add more commercial real estate to their portfolio. And they're doing it in pretty significant amounts, right? About half for less than 250, 30% we're going to add 250 to $500,000 to their portfolio, 7%, $500,000 to $1 million, and 10% we're going to add more than $1 million to their portfolio of commercial real estate this year. So there's certainly a lot of massive capital that's available in marketplaces like ours and others out there. When we look at the asset classes, and Bruce, this is what you were just talking about, this is the kind of order of interest in the asset classes. I don't think anything too surprising here. Multifamily industrial continue to be the highest demand. Self-storage was actually interesting to see that in third. We've seen a number of self-storage properties. They usually do pretty well. We didn't think that was going to come in third. A lot of interest in single family rentals, right? Whether that's a build to rent strategy or buying a portfolio of single family homes. Office is kind of in the middle ground, still a little bit unsure about office, and then retail and hospitality rounding out the bottom. To your point, Bruce, I think there are going to be some really interesting buying opportunities in retail and hospitality now that we're coming out of this the crush that they felt. But what this would indicate to me is that the investor confidence isn't quite there yet to offset those potential returns, right? We've put a freeze on hospitality assets on the platform. We're looking at a few managers right now to try to test out some new hospitality projects just to see what the investor appetite is. This survey would indicate, though, that retail and hospitality are not that high up on the list of investor interest right now. We had to look at some other asset classes. So we asked just kind of, are you bearish, neutral, or bullish on a few different asset classes? Real estate, overwhelmingly bullish. Equities, pretty neutral, a little bit bearish. And then crypto, which I think we had a couple of questions about what's going on in NFTs and crypto, mostly bearish on that as well. So again, just kind of good to always take a pulse when people are looking at where to invest their money, right? There's all these options out there, and we see real estate as a component of that. So we always want to understand how that fits in with other options that folks are looking at. So I think that's most of what we have. We talked about the risks. The number one identified risk right now is interest rates, right? What is that environment going to do to valuations and returns? We've seen interest rates rise substantially. We haven't seen cap rates move quite at all yet. So that's kind of going the wrong way, right? You want to see cap rates going up, interest rates coming down. That's usually better. Equity market volatility, that was kind of in the middle of the risks that we tested. And then COVID recovery was actually one of the lowest ranked risks. So I think most people are feeling pretty good about where we're at in terms of the COVID recovery coming out of the last couple of years. So I think that's all we've got. We've got about 10 minutes left for some Q&A. Tyler, we'll let Tyler jump back in, and we've got some questions that folks had sent in before, and we'll take a few minutes of questions here before we wrap it up.
Thank you, Adam and Bruce and Terry. The presentation was great. We've got a number of questions to get through, and if you would like to add your question to our queue, please remember to hit up that question box on GoToWebinar, and we'll try to get to your question. If we're not able to get to your question today, we'll follow up via email to answer your questions. So question one, this one's for you, Adam. What is the sweet spot for fundraising and deal size? So what amount is kind of the sweet spot to raise on the equity side, and then just from overall deal size, what's that sweet spot?
Yeah, we mentioned that a little bit earlier in terms of where we certainly see the most need for a platform like ours is that 15 to 30 million total acquisition price, right? Those middle market deals where you're not large enough to attract an institutional equity check, but you're beyond maybe where you can syndicate from friends and family. So a lot of the deals that we see are still sub $10 million in terms of total capital that they'll raise through the platform. And I think that's where we've focused on, and we know that that's one of the biggest needs in the capital markets. I think the great thing about the industry now is you've got options, right? Depending on how you're trying to raise a capital or what you want it to look like, you can go to platforms and do a Reg CF offering and get a bunch of investors that maybe are buying into a local project that they have some desire to be a part of, and they want to help out something in their local community. And then you go into the more middle market space, and you can get just kind of purely investment driven folks, and then you can go to some of the other platforms like a Fundrise, and look at them as a more of a they've raised almost $1 billion now for their Reg A properties and their REITs. So I think to me that's the benefit of the space right now, is there's all different types of capital up and down the capital stack in different sizes that are fit for what we're seeing in the space right now.
Thanks, Adam. And Terry, we've got a couple back-to-back questions for you. I'll start with the first one. They're on the structuring a deal for crowdfunding. So the first question is, I would like to understand more about the regulation of crowdfunding versus syndication and any complications that may bring to the asset sponsor.
Well, look, a syndication is usually a group of people that you're bringing together who are looking at the deal in question. There's usually, in our experience, syndications are a small group of people. It's people you have a previous relationship with. They probably have invested with you before. You're giving them information, and usually you would want them to be accredited and all of that. So you find most people, even though technically you're probably supposed to jump through the same sort of hoops, on syndications, you don't see people doing that as a matter of course. When you do a true offering where you're doing a general solicitation, like on a platform like this, you do have to jump through more hoops. You have to do filings, and with the SEC, they're very straightforward. You have to, depending on the state that you're raising capital in, you may have to do some blue sky. A lot of that gets trumped by the federal statute, but you still have to do that work. If you're talking about bringing in foreign investors, there's all kinds of things that can create complexities in a bigger funding or a bigger offering. So, but I don't find most of it to be especially daunting. I think that the part that usually people kind of struggle with the first time is realizing that, unlike in a syndication where you kind of know everybody, so Bob's just going to call you up and say, hey, what's going on with my deal? All of a sudden you have a group of people you've never met who are, you've taken their money, you're managing, you're really overseeing somebody else's money, and you're going to have reporting for them, and you're going to have things that you have to do that you may not do in a syndication vehicle. So I don't necessarily think the regulatory stuff is so different or triggers so much concern or risk, but it is that sort of operational, how many K1s do you produce for a crowdfunded deal versus a syndication deal? And Adam, I don't know if you have like average number of investors in your deals, but I bet you it's probably bigger than what people do in their syndications.
Yeah, it varies, anywhere from 10 to 15 on the small end. We've had deals that have 100 plus, right? And I think the benefit of some of the other software platforms out there from an investor management perspective, RealPage, IMS, Juniper Square, we work closely with all of them. They really simplify a lot of that back end reporting and K1 generation distribution. So a lot of times I think there is that impression that, oh my gosh, I'm gonna have to manage so many investors. There's a lot of really good software out there right now that can help with that operations behind the scenes to ease a lot of that administrative burden for sure.
I do think people worry that, oh, I'm doing an offering and I have to be a registered investment advisor. That is not the case, right? There's an analysis that's done, but most people do not have to become a registered investment advisor and file a form ADV and do all those things. So it is not as scary as it sounds.
Great. And Terry, you just answered part 2 of my question, so we'll move on to the next question. Adam, with cryptocurrencies blowing up, with NFTs, are you seeing anything there with crowdfunding?
Not really. So there was there's a couple platforms that are doing some kind of blockchain-y, trying to figure out how the blockchain applies to the real estate space. A lot of them, though, are just kind of chasing the shiny ball, and they've moved on to the metaverse, right? So they kind of skipped over the whole idea of tokenizing real estate. Now the metaverse is like the next shiny thing. I don't get it. My kids spend, they would spend hours a day on Roblox, and they'll pay, real world money for these digital representations of things. I don't know. We'll see. I think there are some interesting applications of blockchain, and it's something we looked back even in 2016, 2017. Is can you represent physical ownership through an NFT and then split off the cash flow into like a spendable token, right? There's some interesting kind of ownership and governance ways that you can look at it, but I think for that to ever really take hold and become something meaningful, it's going to take a massive change from a regulatory perspective and from a a legal perspective, right? There's no case law that determines what to do when a smart contract is has an error in the code, right? This whole concept of code is law kind of sidesteps the entire legal system, and I don't think that that's going to be a comfortable spot for a lot of people to put significant ownership and money into until there's some understanding around how that's going to interact with the current regulatory and legal system. So interesting, we'll keep an eye on it, but it's not something that we're seeing a ton of adoption yet. But I think there's some interesting things kind of going on behind the scenes. They can almost abstract the blockchain away, and then you have just a more efficient fund administration platform or something like that.
Great. And just as a, go ahead, Terry.
I was just saying, you just have to stay tuned. I think the metaverse, NTF, or NFTs and crypto in particular is making its way into the world, whether people like it or not. And, it's a wealth point now, and people with wealth want to invest, and how are they going to do that? So I think we're all going to eventually have to deal with it beyond just our children.
It's a fascinating space for sure. We're coming up on the end of our time here. As a quick reminder, this is being recorded. We'll send you a recording via email later today. If we don't get to your question today, we'll follow up via email to answer your question. We've got a few minutes left. We'll do a quick just fire round. I'll ask 3 questions. We'll go Terry, then Bruce, and then Adam. Terry, first off, is there a way to incorporate historical tax credits into a crowdfunding strategy?
Yes, you can. The crowdfunding strategy doesn't really change the ability to use things like historic tax credits or LIHTC because it's above the dirt. It's not, all of those structuring issues that you do on those types of deals happen below the equity. So it shouldn't impact it, and there's no reason why you can't do it.
Great. And Bruce, can you crowdfund a new multifamily development project coupled with EB5?
I don't see why you can't. I don't know the answer for sure, but I would think there'd be no reason I can think of why you can't. The only issue is you got people, I guess, usually from China or another country, in one offering, and you got the other offering. But I don't know, Terry, can you see any particular reason you can't?
I don't think that it's a big disclosure process, right? So to your point, but they're separate offerings, right? The sponsor's not a offer under the EB5, and the EB5 is not an offer. Now, if you're getting traditional debt and EB5 and crowdfunded money and historic tax credits and everybody's head might explode. But other than that, I don't know that there's a per se impediment to it. I think traditional lenders get more and more nervous the more non-traditional things you start to do. EB5 became unappealing for a while. I think there's been some reform. I think it's back, but there's no particular impediment, I think.
I kind of like whoever asked the question. I think Terry's right about it, the exploding head, but if that can be, kind of corralled, it may be a really good idea, because the whole idea of EB5 money is it's high risk money that's cheaper because the investor has a different risk reward profile, and it may be advantageous to the crowdfunding investors because they're partially a beneficiary of that. The deal is economically better. So whoever's not afraid of exploding head, and by the way, Terry Adler's special deal, I think if anyone could put it together, it would be Terry. I think it's pretty creative idea.
Well, great question. Thanks for sending along that question. And Adam, last question of the day. At what stage of the acquisition process does it make sense to engage with a crowdfunding platform?
Generally, the earlier the better. So usually we'll get involved once a sponsor has a deal in contract, right? They're in escrow, they're doing their diligence, they're kind of figuring out how they want to structure their capital. Maybe they have the debt lined up, maybe they're still exploring that, and they are out raising equity concurrent with that process. So generally, usually we won't get started until they have the property under control. But if you have an opportunity you're looking at, always happy to give feedback on what we're seeing on the marketplace and what we think investors are looking for at that time. So generally, the earlier the better.
Hey, can I ask one quick question before we go of you, Adam? Because I know it's one I hear a lot. How long start to finish? So somebody signs the contract and says, I got to close in X days, weeks, months, whatever. What's kind of the shortest, the longest, the expected time frame for your offering to hopefully succeed?
Yeah, generally in an ideal world, we like 6 to 8 weeks, right? I think that builds in plenty of time for buffer. You depending on the state of the documents, depending on the condition of the marketing materials, right? Oftentimes it's not us that's holding the process up, to be quite frank.
Sure.
It's making sure that we have all the information. We don't launch a deal until we have a PPM from the sponsor that's final docs are ready to go.
Lawyer.
What was that?
That's those lawyers, right?
Yeah, I know, right? So work with fantastic counsel, and they'll take care of you. But we've seen, we could get a deal live in a pinch in a week, or less, depending upon our capacity and the state of the documents. And then we've seen deals raise capital in, like you said earlier, Bruce, a number of days, even in a day, right? So I think in the optimal time frame, we're going to have plenty of time to run a process and send out a couple emails, do a webinar, and have time for a final call and kind of run a full process. But we've certainly seen it happen significantly quicker than that, for sure.
Okay.
Great, and that wraps up our question and answer time. Bruce, why don't you let listeners know how they can get a hold of you really quick, and then Adam, I'll let you take it away, talk about how to get a hold of Real Crowd, and we'll sign off.
Well, okay, you've got me, Bruce Stackenfeld. You've got Terry Adler. We spearhead the practice. To the extent it's kind of putting the pieces together, it's probably me. To the extent it's anything like, I guess, that requires brain power or really putting the transactions together, making them work, it's really more Terry. But either one of us is available. I think we have our phone numbers, our cell numbers, our email numbers on our website, which is www.DSLLP dog Sam Lira pretzel.com, and call us. We'd love to help. And the last plug for us is this: we have been through the documents on these transactions with obviously Real Crowd, and yes, with some other platforms as well. So the first deal is, I don't know, it's traumatic, but it's getting it going it's got its issues. We've been through that before and can streamline it as much as possible. And really, Terry is a great place to start if it's your first time doing crowdfunding.
Perfect. And for Real Crowd, you can just simply head to realcrowd.com, or you can send me a note, adam@realcrowd.com. On the website, you can find a part of the site for sponsors, has a lot of information on there, pricing, all that good stuff. But yeah, I would love to get an email, and if nothing else, look to either of our firms as a resource as you're thinking about how to capitalize deals and what you might be able to do in the space. So for all the listeners and attendees out there, really, really appreciate you jumping on today. Bruce, Terry, thank you so much for spending your time. As Tyler said, we'll send out a recording to everybody that registered. So thank you, everybody. Hope you have a great afternoon, and hopefully we can do some business together.